Investing in the stock market can be an exciting and rewarding experience, but it can also be intimidating for beginners. Understanding stock market fundamentals is crucial for making informed investment decisions. In this video, we will take a deep dive into the most important stock market fundamentals, including how to analyze a balance sheet, profit and loss statements, P/E ratios, EPS, and more. Part 1. What are stock market fundamentals? Stock market fundamentals are the basic financial metrics and ratios that investors use to evaluate the health and performance of a company. These metrics and ratios provide a snapshot of a company's financial position, earnings, and growth potential. Understanding stock market fundamentals is crucial for investors to make informed investment decisions and minimize the risk of losing money. Some of the most important stock market fundamentals include analyzing balance sheet, profit and loss statement, earnings per share, EPS, price to earnings, P/E, ratios, return on equity, ROE, price to book, PB, ratios, and dividend yields. Let's take a closer look at each of these metrics. Balance sheet. Analyzing a company's balance sheet is crucial when it comes to investing in the stock market. The balance sheet provides valuable information about a company's financial health and stability, which is important for investors to consider before making any investment decisions. Now, we'll discuss the importance of analyzing a company's balance sheet for investing in the stock market. What is a balance sheet? A balance sheet is a financial statement that shows a company's assets, liabilities, and equity at a specific point in time. Assets are things that a company owns and can be used to generate revenue, such as cash, investments, and property. Liabilities are obligations that a company owes to others, such as loans, accounts payable, and taxes owed. Equity represents the portion of a company's assets that are owned by shareholders. Why is analyzing a balance sheet important for investing? It is important for several reasons. 1. Financial health and stability. The balance sheet provides a snapshot of a company's financial health and stability. By analyzing the assets and liabilities, investors can determine whether the company is in a strong financial position or if it is struggling financially. For example, if a company has a lot of debt and few assets, it may be at risk of bankruptcy if it cannot meet its financial obligations. 2. Profitability. Analyzing a company's balance sheet can also provide insight into its profitability. By looking at the equity section of the balance sheet, investors can determine how much of the company's assets are owned by shareholders. If the company has a high level of equity relative to its assets, it may be profitable and generating strong returns for shareholders. 3. Efficiency. The balance sheet can also provide insight into a company's efficiency. For example, by analyzing the company's accounts receivable and inventory levels, investors can determine how quickly the company is able to collect payments from customers and sell its products. If the company has a high level of accounts receivable and inventory, it may be inefficient and struggling to generate revenue. 4. Growth potential. Analyzing a company's balance sheet can also provide insight into its growth potential. By looking at the company's assets, investors can determine whether the company is investing in growth opportunities. For example, if the company has a high level of cash and investments, it may be investing in research and development or expanding its operations. How to analyze a balance sheet? Analyzing a balance sheet requires a thorough understanding of accounting principles and financial analysis. Here are some key things to look for when analyzing a company's balance sheet. 1. Current ratio. The current ratio is a measure of a company's ability to meet its short-term financial obligations. It is calculated by dividing current assets by current liabilities. A current ratio of 2 or higher is generally considered to be healthy. 2. Debt-to-equity ratio. The debt-to-equity ratio is a measure of a company's financial leverage. It is calculated by dividing total liabilities by total equity. A high debt-to-equity ratio may indicate that a company is highly leveraged and may be at risk of defaulting on its debt. 3. Return on equity, ROE. ROE is a measure of how much profit a company generates for each dollar of equity invested by shareholders. It is calculated by dividing net income by total equity. A high ROE may indicate that a company is profitable and generating strong returns for shareholders. Profit and loss, P&L, statement. Analyzing a company's profit and loss, P&L, statement is another crucial aspect of investment analysis in the stock market. The P&L statement, also known as the income statement, provides information about a company's revenue, expenses, and profitability over a specific period of time. Here, we'll discuss the importance of analyzing a company's P&L statement for investing in the stock market. What is a P&L statement? A P&L statement is a financial statement that shows a company's revenue, expenses, and net income or loss for a specific period of time, such as a quarter or a year. The statement is divided into several sections, including revenue, cost of goods sold, gross profit, operating expenses, and net income. Why is analyzing a P&L statement important for investing? Analyzing a company's P&L statement is important for several reasons. 1. Revenue growth. The revenue section of the P&L statement provides information about a company's sales growth over time. By analyzing revenue trends, investors can determine whether a company is generating consistent revenue growth, which is a positive sign for long-term investors. 2. Gross margin. The gross margin is the difference between a company's revenue and cost of goods sold. It represents the profit that a company makes from selling its products or services. By analyzing a company's gross margin, investors can determine whether the company is able to generate profits from its operations. 3. Operating expenses. Operating expenses include costs such as salaries, rent, and marketing expenses. By analyzing a company's operating expenses, investors can determine whether the company is able to manage its costs effectively. If a company has high operating expenses relative to its revenue, it may be struggling to generate profits. 4. Net income. Net income is the profit that a company makes after all expenses have been deducted from revenue. By analyzing a company's net income, investors can determine whether the company is generating profits or losses. Consistent net income growth is a positive sign for long-term investors. How to analyze a P&L statement. Analyzing a P&L statement requires a thorough understanding of accounting principles and financial analysis. Here are some key things to look for when analyzing a company's P&L statement. 1. Revenue growth. Look for consistent revenue growth over time. Ideally, a company should be able to generate revenue growth year over year. 2. Gross margin. Look for a stable or increasing gross margin. A company with a high gross margin is generally more profitable than a company with a low gross margin. 3. Operating expenses. Look for stable or decreasing operating expenses. A company that is able to control its operating expenses is generally more efficient and profitable than a company with high operating expenses. 4. Net income. Look for consistent net income growth over time. Ideally, a company should be able to generate net income growth year over year. Part 2. Earnings per share, EPS. Earnings per share, EPS, is one of the most important metrics that investors use to evaluate a company's profitability. EPS measures the amount of net income earned per share of outstanding stock. It is calculated by dividing the company's net income by the number of outstanding shares. For example, if a company has a net income of $10 million and has 1 million outstanding shares, the EPS would be $10 per share, $10 million/1 million shares. Investors use EPS to determine how much profit a company is making per share and to compare the profitability of different companies. Part 3. Price to earnings, PE, ratios. Price to earnings, PE, ratios are another important metric that investors use to evaluate the value of a company's stock. PE ratios compare the current market price of a company's stock to its EPS. It is calculated by dividing the current stock price by the EPS. For example, if a company's stock is trading at $50 per share and has an EPS of $5, the PE ratio would be 10, $50/$5. Investors use PE ratios to determine if a company's stock is overvalued or undervalued compared to its earnings. A high P/E ratio could indicate that the stock is overvalued, while a low P/E ratio could indicate that the stock is undervalued. Part 4, Return on Equity, ROE. Return on equity, ROE, is a metric that measures a company's profitability by calculating the amount of net income returned as a percentage of shareholders' equity. It is calculated by dividing net income by shareholders' equity. For example, if a company has a net income of $10 million and shareholders' equity of $50 million, the ROE would be 20%, $10 million/$50 million. Investors use ROE to evaluate a company's profitability and management effectiveness. A high ROE indicates that the company is generating significant profits for its shareholders, while a low ROE could indicate poor management or a lack of profitability. Part 5, Price-to-book, PB, ratios. Price-to-book, PB, ratios compare a company's market value to its book value. Book value is the total value of a company's assets minus its liabilities. PB ratios are calculated by dividing a company's market capitalization by its book value. For example, if a company has a market capitalization of $100 million and a book value of $50 million, the PB ratio would be 2, $100 million/$50 million. Investors use PB ratios to determine if a company's stock is overvalued or undervalued compared to its assets. A high PB ratio could indicate that the stock is overvalued, while a low PB ratio could indicate that the stock is undervalued. In summary of this video, analyzing a company's balance sheet is essential for making informed investment decisions in the stock market. By understanding a company's financial health, profitability, efficiency, and growth potential, investors can determine whether a company is a good investment opportunity. And a company's P&L statement is also crucial for making informed investment decisions in the stock market. By understanding a company's revenue growth, gross margin, operating expenses, and net income, investors can determine whether a company is a good investment opportunity. When analyzing a balance sheet, it is important to look at key metrics such as the current ratio, debt-to-equity ratio, and more. And when analyzing a P&L statement, it is important to look at key metrics such as revenue growth, gross margin, operating expenses, and net income to gain a comprehensive understanding of a company's financial health and stability.